Okay, so continuing on, let's look at number 15 of chapter 11. So number 15 says, in 2016, Rice contributes non-depreciable property with an adjusted basis of $60,000, and the fair market value is $95,000. So remember, this is what that will look like. The partnership is called Montgomery. I'm just going to put Montgomery Partnership. And Rice is one of the partners. And he had contributed property, non-depreciable property, with an adjusted basis of $60,000, fair market value of $95,000. So we all know that that is called a built-in gain. A little messy. Okay, that's called a built-in gain. Okay, so the question is, okay, in 2017, when the property's fair market value is $100,000, the partnership distributes the property to Jarvis, who is another partner. Okay, so that same property that now has a basis at Montgomery was distributed to Jarvis for when the fair market value was $100,000. Okay. This was next year. So they tell us next year for a reason. There are some circumstances where non-recognition does not apply, and one of them is whenever we have a transaction where it looks like the partners are just using the partnership as a means of moving assets from one partner to another. So, but this happened the following year, so we're okay here. Okay. So the question is, which partner must recognize a gain, and what is the amount of the gain recognized? Okay, what is the effect on that partner's basis and the partnership interest? So the partner that's going to recognize a gain is going to be Rice. Rice recognizes that $35,000 gain. That was a built-in gain from whenever he contributed it. Okay? And now Jarvis has the property with a basis of $95,000. Okay? It's not $100,000. That's the fair market value. All right? He's just going to recognize the amount of the $60,000 basis of the property plus the built-in gain when it transfers to Jarvis. Okay. All right, number 16. In 2015, Dudley contributed land to the Prosperity LLC. His basis was $100,000. The fair market value was $110,000. So again, we have a built-in gain, right? The built-in gain here of the land is $15,000. In 2006, a year later, the LLC distributes other property with an adjusted basis of $60,000 and a fair market value of $90,000 to Dudley. So these are two transactions, one year after another, with the same partner. In the first year, the partner contributed property to the partnership that had a built-in gain of $15,000. And then in 2016, the LLC distributes other property with an adjusted basis of $60,000 and fair market value of $90,000 to Dudley. Okay? Dudley's basis and his LLC interest was $50,000 immediately before the distribution. Okay, so it wants us to know how much gain Dudley should recognize and how much is his basis after the distribution. Okay, and then what's the LLC's basis in the land Dudley originally contributed. Okay, so a lot of information. It's always helpful for me to write, to draw little charts to show what went in and what went out. So Dudley is our partner. We don't even care about the other partner in this particular example because the other one is not mentioned. So Dudley is going to contribute in property basis 100,000, fair market value 115 equals built-in gain of 15,000. The next year, Prosperity gives Dudley, and I'm just going to draw it this way so we can see. I'll put it on the other side. This was a distribution of other property, and the adjusted basis was 60,000. Fair market value is 90,000. Okay. All right. So the Dudley is going to have to recognize the lesser of the built-in gain from when he contributed the property, which was the 15,000, or the built-in gain of the property that was distributed to him, which was 30,000. And of course, the lesser of is the 15,000. So if he's going to recognize that gain, we need to add it to his basis so that it's not being double counted. Okay? So Dudley's basis in the partnership, which again is called the outside basis, was 50,000 before the distribution. Then he recognized the gain, which was the lesser of the 15,000 or the 30,000. So we add that 15,000. So now his basis is 65,000. Okay. All right. Next, let's do number 21. Okay, on this one, number 21, the Lexington Partnership has depreciable business asset, personal property, that it originally purchased for $60,000. The asset now has an adjusted basis of $36,000 and a market value of $70,000. So remember, we calculate adjusted basis equals the cost minus accumulated depreciation, right? Okay, so we know the adjusted basis of that property is how much? $36,000. The cost was $60,000. So the accumulated depreciation has to be equal to $24,000. Okay. All right. So the partnership has no other potential hot assets. All right. Ambrose sells his 25% interest in the partnership. How much is his depreciation recapture potential? Whenever we have depreciation, there's a possibility that we may need to recognize depreciation recapture, which means that we need to add income onto our tax return. Okay, so his depreciation recapture could be the total amount of accumulated depreciation, which is our $24,000, times his percentage of his partnership interest, which is 25%. So he may need to recognize up to $6,000 in depreciation recapture. Okay, so it's $6,000. And depreciation recapture is considered ordinary income. Okay, number 22. This one is about Section 754 adjustments, which is when a new partner pays more for a partnership interest than what that partnership interest has a basis of. So, for example, in this case, Doosan is a member, and Doosan Adele for $35,000. Okay, if we look at the basis, then the basis says that Doosan's capital account should be only $30,000. Okay, but Adele paid $35,000, so that means the 754 adjustment is going to be $5,000. Okay. And now, what is the amount of Adele's basis and the acquired interest? Her basis is whatever it is she paid for it. So her basis is the $35,000. Okay. So as you can see, whenever she contributed her, whenever she bought into the partnership, everybody's capital account went up by the same amount because they're still 25% equal partners. So now, instead of their basis being $30,000, the outside basis $30,000 for each partner, now it's $35,000. And you can see that the depreciable asset is what stepped up whenever we have a 754 adjustment. So the depreciable assets are stepped up, which means that we'll have more depreciation deductions in the future. And who do you think gets to benefit from the more depreciation deductions? It's going to be Adele. So even though they're equal partners, she's going to receive more of the deduction for depreciation because she paid into the partnership. She paid into the partnership more than what the partnership's basis actually was. She'll get the benefit of more depreciation in the future.